Welcome to the Stash Cast, where innovation meets real estate. Let's dive in.
All right, George, thank you so much for joining me today. I'm super excited to speak with you, and I'm glad you were able to set aside some time today.
It's my pleasure to speak with you.
I know who you are, but for the folks at home, why don't you just give a brief background of who you are and what you do?
Sure. I am a commercial real estate broker with CBRE, specialize in selling multifamily properties. I am on a team of 12, so I'm one of 12. And we work selling apartments in Indiana and secondarily in adjacent markets occasionally with colleagues. I've been doing this my entire career. I started my career with what is now CBRE. It was at the time Coldwell Banker, and I was there for 20 years. And then in 2005, I started my own boutique firm, Tikijian Associates. We were then purchased by Cushman & Wakefield in 2018. And then at the end of 2023, CBRE recruited me and my team back to CBRE. So I'm back to where I started. I was here for 20 years, gone for 20 years, and now back.
That's great. And that's actually a good lead in. What was it that drew you to commercial real estate brokerage? And have you always been in multifamily investment sales?
Nothing drew me to multifamily brokerage. I fell into it.
Okay.
I was on the track to be a banker. I went to Indiana University, got a degree in finance, and in 1984, the year I graduated, most finance majors ended up going into banking. There was like 18,000 banks in the country at the time. So most of us went into banking. I just happened to, I had a banking class at IU where a CB broker 3 years earlier had the same professor, and he was looking for what was called at the time a runner, an apprentice. I raised my hand. I ended up meeting him. I had an interview, and a few months later, I ended up accepting a job with CBRE, with Coldwell Banker here in Indianapolis. And he was an apartment broker, so that's what I ended up doing. I wasn't really even thinking about commercial real estate before that. I can only imagine what my banking career would have been like, how many banks I would have worked at, because there was so much consolidation in the 80s and 90s and even early 2000s that most people who I know who went into banking are either not at the same bank or the bank certainly doesn't have the same name. And obviously, as you well know, brokerage is a much more entrepreneurial business. And I am more entrepreneurial than I would have been as a corporate banker.
Yeah, probably. I can't, candidly, the reason I'm in real estate brokerage is because nobody would hire me. I don't like being told what to do, which is the blessing and the curse of being in commercial real estate brokerage.
So to go back even further, the reason they hired me at CBRE, it was very hard getting a job back then, as it is now with the big real estate firms. The reason I was hired, that's the guy named John Watson who hired me, who you may know John because he's principal of Core Redevelopment, and they redeveloped a few properties in Cincinnati.
Yeah.
The two schools. He's the one who hired me. He's 3 years older than me and needed a young apprentice. But the reason he thought I was even worthy of the job, I wasn't, I don't think, a particularly good interviewee. But in college for 4 years, I'm from New Jersey. So we moved to Indiana when I was in junior high, but my family still had a place at the shore in New Jersey. So in the summers, I went back to New Jersey and I got a job while I was at IU in the summers as a good humor ice cream man. And which is a bigger deal in New Jersey than it is here in the Midwest. Good humor men are well known in New Jersey. It's a more densely populated state, and neighborhoods, houses are more tightly packed together. So Ice cream man is a viable summer business, whereas here, at least in Indianapolis, the ice cream man are looked upon as sleazy guys who drive trucks, but it wasn't
Yeah.
that way. So that was a very entrepreneurial business. I bought my ice cream at wholesale, sold it at retail, rented the vehicle, and worked many hours until late at night looking for kids who wanted to buy ice cream and candy.
Amazing. That's awesome. You know who else was an ice cream man? Was PBD, Patrick Bet David. I just heard that the other day.
Ah,
No, he's from Sherman Oaks, California.
okay.
Huh. So I guess that was the early lead in for you about what made you feel that, because brokerage, as you mentioned, is very entrepreneurial. So I guess did that give you the confidence to go and say, yeah, I can sell this.
That's where I learned about there are some businesses, the more you work, the smarter you work, the more money you make.
Yeah.
So that is really what appealed to me. It's a little crude, but our business of brokerage is really all about making money. I don't desire to be the manager of the office or even the president of CBRE. That's not what I'm striving
Right.
for. I'm striving for making money. Now, I've always done it with a very long-term perspective. So it's not making money today or on this deal. It's building a business over time that pays dividends over time to make money. And that's always been my approach to it.
That's a really good way to frame it. And so I'm curious if you could maybe expand on that a little bit more, because I think a lot of people look at what we do, especially once we have established our brand, and be like, oh, it's easy, but it's not.
It is a very hard business to start. The business is quite different today than it was in 1984. In the 80s, it was really the Wild West. It was cowboy brokers working on their own, trying to do deals. And there weren't so many teams in apartments in particular. The Reagan tax law in 1981 basically created tremendous incentives to own real estate and apartments in particular. From 81 through 86, the business was primarily syndicators raising money to do deals that provided tax losses to investors. It wasn't a cash flow business at that time. So prices went up because the more you paid for a property, the more write-off you got. And again, it wasn't a cash flow business. So at the time, the syndicators were out making offers on properties. So when I started in 1984, I was the fifth apartment broker in the Indianapolis office of what is now CBRE. All five of us, or four, were all independent, working on their own. They would collaborate sometimes, but they were all chasing their own deals. I was working with John Watson. And so you mentioned the 86 tax law. So by 86, that tax law took away those benefits from apartments in particular. And immediately it was a 30% drop in property values across the board because you're taking away the ability to write off income with passive losses. That's what that did. So no longer would anybody buy a property for the losses. It had to be cash flowed. So those properties were purchased at premium prices and financed at premiums so that the business just ground to a halt. By 87, I was the only of the five brokers, I was the only one left in the Indianapolis office. And the reason I survived is I was very young. My standard of living was as low as it gets, right? It didn't take much to survive. And I was mostly working on really small deals with mom and pop owners. Those weren't really tax syndicated deals. They were more cash flow deals. So while property values dropped, they didn't fall off a cliff. Because from 81 to 86, a very high percentage of the larger properties in the market sold to syndicators. So all of those larger properties you could not sell because they were worth less than they paid for them, and in some cases worth less than the debt. But the little deals you could sell. So not only was I the only one left in the Indianapolis office, there was no other apartment brokers left in the market period in Indiana. All of our competitors had also gotten out of the business because the business literally ground to a halt, and people had to find an alternative living. So from 87 to 89, I slowly was getting better, still mostly selling little deals. And maybe I'm giving you too much history. I'll let you
No,
talk.
this is exactly what I want. This is
Okay. So starting in about 89, all of those syndicated deals that were overfinanced, they started defaulting. And so by 89, the lenders were starting to take properties back, and they were looking for brokers to sell them. And they obviously would sign exclusive listings. So I went from being the young guy, the lowest on the totem pole, to being the only guy there. And when those REOs started coming in, I was the one because I was the only one in the market. So from 89, 90 to about 95, all I did was sell REO deals, a lot of properties for Freddie Mac, some fewer for Fannie Mae, savings and loans, all of them. A lot of the savings and loans financed the deals for the syndicators. And a lot of the syndicators were based in Nashville and Dallas. Again, there's a long story there, but so a lot of those were savings and loans. They take the properties back, and I sold them properties that would have sold in 81 through 84 for 30, 40,000 a unit. I was selling for 10 to 30,000 a unit. And so I then became the big man on the totem pole because I then built a resume and continued from there. But the other part of the story that I had talked about earlier, I was never just a pure salesman. I was all about building a business. So the other thing I did, because I was not comfortable making cold calls, just purely, hey, I'm George, do you want to sell your property? That was never my shtick.
Yeah.
It's probably more your shtick, Stash, and it's certainly more Hannah's, my partner's shtick, just more comfortable doing that. I was not. So I started developing data and databases. And again, this is way before there were any third-party companies that did that. So from 84, because I was hired, the first thing I did when I was hired was gather some statistics. We did rent surveys and stuff like that. So I just kept on doing that and never stopped doing that. So from the beginning, let's say from 89 through about 2005, 7, 9, whenever CoStar decided to start collecting multifamily stats, because, they started in the office at industrial first.
Yeah.
So from that period of time, at least in Indiana, I was the only source of market data, and certainly the best source of market data. Because again, I made that part of my business. We did that continuously every year. And so that helped establish credibility. And then by 2008 or 2010, or maybe even later than that, whenever CoStar got going in data collection, we still collect data because I still think it's better than CoStar and Yardi, but it's not as important in the business now. It just helps us with our underwriting.
The Stash Cast is brought to you by Needle. What if you could use data and analytics to predict real estate transactions? With Needle, you can. Check it out at needle.us to learn more.
It's fascinating. I've always heard about you that you're more of a businessman than a traditional broker.
Well, and that was really the impetus in 05 to leave CB. Let's see, at the time it was called CB Richard Ellis. When I left CB Richard Ellis in 05 and started Tikijian Associates, I thought I can do this just like CB. I can do it better. Because really, the other thing about the apartment business, it was always up until, let's say, 2010, it was always the stepchild of big brokerage companies because most of the big brokerage companies were office and industrial, secondarily retail focused. Multifamily is residential, right? It's investment sales, it's residential. They never really knew how to deal with it. So all those years in my first career with CBRE, we were really on our own. That was another reason we had to gather our own data because there was no company database like there was for office and industrial.
Apartment data is so fractured because
Right.
you've got a 500 unit property of 500 different rental rates.
It's
And lease
fractured.
term.
Certainly knew how to track that data. It just wasn't a priority for CBRE at the time. Now, of course, after the 2008 downturn, when apartment values started really going up a lot because of the single family downturn, that's when all of the big companies made multifamily investment sales a very high priority. And today it's one of the top priorities. That's why we're back at CB, because they wanted to improve their multifamily team in Indianapolis. So they hired the better team, and that's why we're here.
Interesting.
You want to tell me, can I ask you a question? Or,
Yeah.
so tell me, how are you enjoying being at a bigger firm, Cushman, coming from a smaller, a little more boutique firm?
Yeah, I love it. It's great. I have always been with smaller companies throughout my career, which I think has made me scrappier, so to speak. But now it's okay. We have the horsepower and we also have the brand. And it is interesting. You don't know what you don't know until you know it. And just having that social credibility in the larger market is a fascinating thing to be witness to and be a part of.
And so that goes back to some of my decisions. So I left CB in 2005 because I could do the same thing better at Tikijian Associates. We were a boutique firm, provided the same level of service. And then by about 2018, not having a national brand became a little more important. We were doing fine. We didn't have to do anything, but we decided that having a national brand was important. So that's really one of the main reasons we sold Tikijian Associates and went to Cushman. I've also determined in the 5 years that C is the best brand. You can argue with me, I would get that, but
I'll beg to differ, but yes.
from a multifamily standpoint, there's no doubt in my mind that CBRE is the best brand. Again, Cushman's a great brand, JLL's a good brand, Newmark's a good brand, but CB's got the longest standing, probably biggest platform. And that's why we're here.
Yeah, that's fair. So when you're talking earlier about the 80s, did the tax law also apply to development too?
First of all, I tell people, if you want to read about what brokerage was like in the 80s, read a book called Winning Through Intimidation. Robert Springer.
Yeah.
So that book, that guy, who the book was written about, was an apartment broker in the 70s and 80s. And that was, it was ultimate cowboy brokerage, right?
Yeah.
Inserting himself in a deal, getting in a deal, not necessarily providing the best service, just getting in a deal. That's the way the business was. Now I forget your question. What was your, what was it like in, yes. And so in the 80s, when the tax, just like in 2023, interest rates rise, right? What happens to development? The numbers don't work anymore.
Yeah.
Right. Same thing happened in 1987, and it had a big negative impact on values. So the rental demand was still there, but the numbers didn't work as well. So development did slow down and didn't really pick up substantially until the later 90s. Don't forget, in places like the Midwest, like Indiana, Ohio, apartment values and apartment rents had been held down by single family housing and competition with single family. Now, it got dramatically worse in 2001 after 9/11. If you recall, the Fed lowered rates dramatically. And then Also, the government put in provisions to spur single family housing. So from 2001 to about 2006, the apartment rental market was terrible. There was very little rent growth, lots of concessions because people could move out of apartments and buy homes. You talk to some developers who built both homes and apartments, and during that period of time, they would tell you it was easier to qualify a buyer to buy a home than it was to qualify an apartment renter to rent an apartment. So that was really a stagnant period of time because of competition from single family. So again, that's a big reason why in 2008, or call it 2009 and 10, after we recovered from the job downturn,
Yeah.
apartments took off and never really stopped until rates started going up in
Right.
23.
Yeah. As you're speaking, so many things in my mind are just clicking. That's why, because I'm sure you get this all the time. We want 80s and 90s, like value add. And there's just not that much product. And so it makes a lot of sense what you're saying as to why.
Well, also there wasn't as much 80s products because interest rates were very high in the 80s. And when I started in 84, a mortgage for apartments was, I think, 12%. Fannie Mae, Freddie Mac loans were 12.5%. And even though the baby boomers were still growing and the demographics supported more rental housing, it was harder to make the numbers work.
So what were the cap rates like when interest rates were 12%?
So that's when deals got much more creative. The cap rates were, for a long time, the cap rate was 10%. So if the cap rate was 10% and you had a mortgage of 12%, there was creative financing. There was wrap mortgages, second mortgages, and this was all before the securitized market was a primary lending source, where they started prohibiting secondary financing. So you can get more creative with banks, and S&Ls would allow multiple tranches of debt. Sellers would carry back financing at below market interest rates to support higher values.
Yeah. And
so with the Wild West of lending, you have a less efficient market. If you and I today do a BOV on a property, assuming neither of us is smoking weed or trying to buy a listing with a high price, we're going to be pretty close with value, right? Because
Sure.
the inputs into value are pretty stable. Back then, you could finance it all different ways, and values could be very much more greatly. It wasn't as efficient a market.
Yeah, that's fascinating. It makes a lot of sense. And S&Ls were even allowed to put in equity into deals, weren't they?
Yeah.
Yeah. Not allowed to do that anymore.
Actually, they can, they're just limited.
Oh, I didn't know that.
First of all, there aren't really S&Ls too much, but
Right.
savings banks do have the ability to own real estate, but they're more highly regulated and they will use a lot more capital. They have to reserve a lot more capital for that. So they don't do it because it doesn't really make sense for them, for savings banks.
Yeah. Makes a ton of sense. So I'm just absorbing it. This is great. I'm really loving it.
The history of multifamily, the modern history of multifamily, at least
Yeah.
from the 80s on.
Was that just the technique that was in vogue, or that was the cheapest way to do it?
That's just how people developed. My guess is roof trusses and framing technology probably weren't as advanced in the 60s. It's pretty consistent. That's just the way things were built back then.
I bet if you look at the rise of manufacturing facilities that create those roof trusses, it would correlate with pitched roofs. Awesome.
And asphalt shingles. I don't think that maybe they came down in price. Maybe oil prices came down and it made asphalt shingles more viable. I'm sure there's all kinds of engineering and materials science that played a part in what was the cheapest and most cost-effective, right?
Yeah. I had a podcast the other day with a guy that was talking about magnesium oxide board, and he's in Florida, and this is missile proof. That's amazing. So that'll be coming out soon.
We don't have missiles flying through the air in the Midwest.
No,
They do in Florida during hurricanes.
we get an occasional tornado, but not to the extent as hurricanes and the damage swath is not as wide as a hurricane
Right.
does. Okay, so you left CBE. It was CBE
2005.
Yeah, in
Right.
2005.
So I took one person with me when I left CB in 2005, I was the very first one in the Indianapolis office to even create a team. And I think it was in 91 or 2. I had a team. I had a marketing specialist, which back then all you had were secretaries and brokers, and that's it. I
Yeah.
actually had somebody who was a marketing person to help us do marketing and materials together. So we had a team of 4 when I left. One of them came with me. I hired another fella, Cardi. And so initially there was 3 of us. We expanded to 4 within the year, expanded to 5 within 2 years, and then expanded to 6 by 2008. So Hannah joined me in 2008. In fact, I remember her first day. Her first day was September 15th, 2008. That was the day Lehman Brothers filed bankruptcy. That's right. That's the day she joined me. She had been in the business on her own for, I think, 6 or 7 years before that. A couple in Indy, but in Memphis and in Florida before that.
Okay, interesting. Which is fascinating.
Now we have 12. We have 12. So of the 12, we have 6 salespeople. So we have 6 non-salespeople. They are 2 analysts. And one of those analysts wants to be a broker one of these days. We have 2 marketing people, and we have 2 transaction people. And then we have 6 brokers, salespeople. So you've got me with 40 years experience, Anna with 25 years experience, Cam with 7 years experience, Claire with 6 or 7 years experience, Ryan with 3 or 4 years experience, Sean with 1 year experience. So I enjoy hiring people right out of school and training them to be brokers. I'd rather hire somebody with no experience, but all the raw talent, rather than hire somebody with experience and have to.
Yeah. So when you onboarded a new associate, do you have them drive the market? Do you have them make buyer calls? Like, where do you direct their energies? How do you make sure that, because what I've seen personally, and I almost felt victim to it myself, is that new brokers tend to get lost in their spreadsheets. You have all this energy, you want to make however many calls I have to make. And then you get somebody on the phone and they start asking you questions and you're like, oh, I don't know. And then the mentality is I have to know everything about a given property or the owner and everything they own before I even make the call. And so you end up spending a half hour researching each person, and then you get a voicemail, and then you do it for the next one. And so and I had a broker, his name was Bruce Haynes. He was in Southern California, and before the RTC, he was bigger than Marcus Millichap. He had 9 offices, 15 offices, something like that. And that's where I learned cold calling from, because I started to get lost in my spreadsheets. And he called me into his office, sat in front of his big oak desk, and your only job is to be on the phone. Nothing else matters. Just be on the phone and set appointments. And, okay. But I'm trying to how do you train these people up?
Yeah. So we have a very different philosophy. What you've described is the Marcus and Millichap approach. They hire a bunch of young people. They sit them down at a desk and say, make a lot of calls. Most of them won't make it, but a few will, and they'll get over the hump. What we do is because we're investment sales, right? So we're selling an investment product. So we make everybody be an analyst for at least 1 year. We try to go for 3 years, but people get anxious and they're ready to go. First thing you do is you're an analyst, and we do a lot of BOVs. Right. These days we're doing 500 to 600 BOVs a year. So we need people, analysts. So we train them on that. They get to know the numbers. Then after, let's say, a year of just crunching numbers, and again, we all sit together. We have no offices. They hear us, right? So they hear the sales process on the phone with the experienced brokers, but they're doing their number crunching. Then what we have them do is on our listings, make calls on buyers. And it's all the people that sign the CAs and download the OMs that you don't know who they are, who aren't like the target buyers. They call them because sometimes those people who you have no idea turn into buyers.
Sure.
So they call them. So they then have to, so they understand the numbers because they've been an analyst for a couple of years, and they spend time making sure they understand the property. And we always, in our OMs, we talk about why do you buy the property? We have investment highlights. We have the pitch, right? So they call buyers, and then we'll do showings. And they go on calls, buyer calls or meetings and showings with me and Hannah, and they learn through osmosis. We never send people out on their own in the early years. We don't want you talking to people if you don't know what the hell you're talking about, because we have a reputation. So anyway, they do that. And then let's say in year 3, they're calling on our buyers, or they're calling buyers for our listings. Then they start doing prospecting. We'll figure out what segment of owners you should prospect with, so that not everybody's calling on the same people. And then they'll start prospecting. They'll prospect, they'll get somebody who says, yeah, I'm interested. So then the whole team works on it. We'll do a BOV. I'll look over their shoulder. We'll make sure that the BOV is right. I'll know what the flaws are in the property because we have experience doing that stuff. And so then we'll go in with the pitch, and it's hard to lose. Even though this young person found the opportunity, we will come in and pitch it as a team. Mm-hmm. So they then we will get a listing. They will be the lead broker. By then they know what to do. And maybe somebody newer and younger helps them make calls. So that's how we evolve into brokerage. It takes 5 years to know what you're doing, and it takes 10 years for the business to keep coming without you constantly having to scramble. And it is much easier to do it from a team standpoint, right? Yeah. So these young people join our team, and they can't make as much money as if they were on their own sort of cold calling, right? But their chances of making money are quite a bit higher here because we're going to bring in revenue and we're going to share it with them. And then the splits, they change over time as people add more value to the transaction. So what that does to me is I've got more people on the team. Hopefully the pie is bigger, right? So even though we're splitting it more, I'm getting parts of deals that I likely wouldn't have sourced and listed. And then also, I don't have to do everything. I've been doing this 40 years. There's things I like to do and things I don't really like to do. So I get to do what I like to do. And the young people are doing the things that they need to do to build their own career.
No, nothing's ever really bulletproof, but that is a great solution to be able to.
But what it requires, and this is where it breaks down, and I'm going to pat myself on the back here, and Hannah, it requires senior brokers that are willing to split and train and take responsibility. And again, think of it as a business, not as just sales. That's the way I've always done it. That's what it takes. There aren't that many teams that last very long because most of the leaders are either people that can't stay focused or they got a big ego and they want to make all the money. And I'm okay sharing.
Yeah, same. I think we share that philosophy. I started off on my own, and then Nate and Sharif both joined me within 2 months of each other in 2014. And we've been together since. We've got William, who's tremendous, and Nash, our analyst. And then we joined up with Don and Jordan here. And it's a similar philosophy. You're obviously a little bit more evolved, but yeah, you allow people to do what they are best at so that you can go and do what you're best at.
You give the client the best team and the best resources, then the client is the seller or the buyer once we have a buyer lined up. We want to give good service on all aspects of the transaction. I mentioned transaction coordinators. So something I started a long time ago. Most brokers have a history of once you get a buyer, the buyer starts working on a purchase contract, and then a lot of brokers move on to the next thing and just wait for the deal to progress to the point where it closes and they make their commission. If you go to a closing and there's an argument between the buyer and seller, and usually the argument's about money, and sometimes there's a gap. And what do they do to fill a gap at closing? They look to the broker.
Yeah.
So I learned a long time ago, it started off with me this is when I was largely by myself even. I wouldn't just hand it over to a title agent and say, here you go. I would stay very involved, gather the information, and do the closing statement. And make sure that before closing, buyer and seller are in agreement, because it's amazing. You negotiate properties in the hundreds of thousands of dollars, but boy, at closing, you argue over tens and hundreds of dollars.
Yes.
So I learned that early on. So I made sure in advance of closing, because again, when you're sitting down there, they look to you, say, you solve our problem out of your pocket. So I learned to not let that happen. And that just evolved into the way to make money is to ensure the greatest likelihood of closing a deal. How do you do that? Number one, you get a listing. So you control the real estate. And then number two, you control the process. You control who the buyer is. And then you control the due diligence and the closing. These are all things learned over a long career that I am able to more rapidly relay to our team because I've experienced it. So we do a whole bunch more due diligence before we get a listing and before we put it on the market to make sure we find problems before they become deal killer problems. So these are all services we provide to the seller, whether they appreciate it or not. The ones who have sold properties and know where problems come up. The ones that are less experienced, they don't get it until it happens to them.
Until they find it.
Right.
Somebody finds it. I need a TC.
I don't know how any of our competitors can compete with us without one, because sellers love it. Sellers love it because we do all the due diligence. And so when you and I are working on a deal, let's say we've got a deal, it's under contract, the buyer's doing due diligence, we're out doing whatever on meetings, on the phone. Due diligence keeps on coming, right? Somebody has to pay attention to it. Our transactions are chained to their desk. And when the emails come in, say, can you send us this T12 or this survey or whatever, they're not waiting for me to get back to my office or the next morning, see the email. It's done right away. And then we organize it. We make it as easy as possible. We anticipate things.
What do you say when somebody says, hey, you have any off-market deals? What do you have off-market? We don't want to buy anything on market.
I say we don't do off-market deals. And a lot of off-market deals that we have done start as properties that are going to be listed. But somebody comes along and says, I need a deal, or this is what I want, and this property works. And the seller is willing to sell it at a defined price without a full marketing effort. Some sellers are willing to do that. What we don't do is somebody says, I'm looking for an off-market deal, and I'll call an owner saying, hey, I've got a buyer. Because that is not in the seller's best interest. Now, that being said, there are some sellers that will do those, and we've seen like there's been more of them There was a lot when things were crazy in 21, 22, because the buyers were coming from the East Coast and buying deals and making crazy offers and closing. Now, those buyers can't necessarily close, but there are sellers still willing to do off-market deals. So some of the properties that trade are not our deals if they're off-market. I don't let it bother me. I'm in this for the long run. If
Yeah.
somebody doesn't appreciate our service, want our service, what am I going to do about it? I'd rather spend my time providing a service than chasing deals. We're not deal chasers. We're business chasers. We're not just deal chasers.
Yeah. That's a good transition of a question. How do you make sure that you're aligning interests and then making sure, because for those that don't know, the brokerage cycle is you usually give it back to the broker that brought it to you almost by default. You still have to earn it. So how do you go about fostering and then maintaining those relationships over the long run so that there is no question when it is time to sell? Because candidly, George, I've talked to people and they're like, we use George and Hannah, and I got to respect it. I love it.
Well, we do get listings where we weren't the incumbent because in some cases our competitors just aren't as good. They may have had a listing and the buyer bought it, but when it comes to marketing properties, we have a better system and a better team. So we do get listings where we didn't sell it to them. But maintaining relationships over a long period of time is one where usually there's some relationship building, right? So there's some people you can build relationships with. You can talk to them on a regular basis and they become your friend. But most of our clients, they don't really want a friend. They want somebody to make them money, right? People want us to make them money. So what we do is when they need something from us, we give it to them. We do a lot of BOV that we know are not listings for whatever reason, wants to know why their property or their portfolio, what it's worth. And we'll do it. We don't say, we did all this work, why aren't you giving us a listing? We don't do that. We just keep giving good service. Or there's people that will call and say, hey, I'm looking at this deal that your competitor has. I'd love to hear your insight on the property because most of the properties I know something about. And I don't say, you know what, not my listing. You talk to the listing broker. So we continue to provide service. We continue to provide what people need. And we try to stay in touch. Now, I will tell you, I am not the greatest at staying in touch with people because I'm just not a great pure cold caller or even warm caller. So there's owners who I don't talk to for many years, but they know I'm active and they know we're doing a lot of business. So we make sure the world knows we're very active. You probably see some of our self-promotional emails. So we do that because we can't talk to everybody on a quarterly basis. Now, the younger people, they are talking to their customers or they're trying to on a quarterly basis.
Right.
That's just, I don't know how else to keep in front of people.
No, it makes a lot of sense. I asked Michael Bull yesterday, how do you build relationships? He's doing office and that's a lot of REO. And he's like, it's hard. It's not easy. There's no magic bullet or secret. The harder you work, the luckier you get.
It's working hard, working smart, and staying at it for a long period of time. And there aren't many brokers that do it for a long period of time.
That's a good topic too.
Most brokers see greener grass, either earlier in their career or later in their career. And I look at myself saying, just think, if 30 years ago, I had started buying properties, my net worth would probably be higher. Assuming I didn't do stupid things, but I don't think I would. But that's the problem with, I've had almost no bad years. Some years we make more than others, but I've not had bad years for a very long time. If I had a few bad years, I might have been inclined to, you know what, I'm going to go do something else. But when you keep making money, it's hard to get off that treadmill.
You helped your son get into the business. It sounds like he's doing very well with a shop in town.
Helping my son get into the business gives me more credit and him less credit. I helped him get a summer internship. And
I wasn't trying to take anything away.
No, I get it, but he did the rest, and he's moved up the food chain at Virgin Health, and he's a highly valued member of the team there. He loves his coworkers. I've got a daughter who's also in the business. She works at Thompson Thrift. She's on the corporate side. That's why maybe you don't know her, but she's the director of communications at Thompson Thrift. And they do a lot of good communications. So she's doing great there as well.
This has been a great conversation.
And even while I'm bragging,
Please.
my son in less than 30 days is going to give me our first grandchild.
Oh,
so
that's great. Congratulations. Congratulations, George.
Thank you.
Yeah. I heard you have llamas too.
No, we had donkeys at one time,
Okay.
but we don't anymore. We live in Zionsville and we live on 8 acres with a barn. And we had a horse at one time because my daughters used to ride. And then we got donkeys to keep the horse company. And then when my daughter stopped riding the horse, we rehomed the horse and got another donkey. But we don't have any outside animals anymore. No more donkeys and horses.
I heard that you had to get up every morning and feed them in the mornings.
My wife would dispute that vehemently. She would get up and feed them. I did not take care of the donkeys and the horses very often.
Let's see. I think we've gotten to most everything I wanted to cover. So I just really appreciate you carving out about an hour here. Thank you so much.
My pleasure, Stash. It was nice to get to know you.
For sure. Absolutely. I hope you have a great rest of your day.
Bye-bye.
That's it for the Stash Cast. Subscribe, share, and stay ahead in commercial real estate and prop tech. See you next time.